Hey, my name is James Nicholson and welcome to my YouTube channel. In this video, I want to talk about a big pivot by one of the UK's leading banks. They were predicting house prices were going to drop this year. They've changed their stance on that. In this video, I'm going to share with you how much they think house prices are going to increase, how many times they think interest rates will drop, and when exactly they feel interest rates will drop as well. This is a big turnaround from their forecast previously. Now, this has happened with their stock, well, basically their annual reporting. They have to report on their profits and losses and what they feel the market's going to do. And that's why we've got this insightful data here today. Now, before we jump into this, as always, if you haven't done, subscribe to the channel over there and hit the bell notification. We're on the way to 23,000 subscribers now. Can we hit 50 by the end of the year? That's our target. And while you're here, smash the like, tickle the like, do something to the like button that makes it turn blue. That's your goal. And doing that really helps the channel, gets more views on the channel. So take a moment to do that right now. So what's going on? Well, Lloyds have come out with their financial reports and they were quite negative last time round. And they were saying that they expected UK house prices to drop. In fact, they were one of the only places saying that at the time. And they were saying that house prices in the UK in 2024 would drop by 2.2%. They've changed their mind on that. And that's really, in fact, it's quite a big jump. They're now saying house prices will rise in 2024. So this is house prices will rise by 1.5%, so nearly a 3% flip in their data. Now, why is this? Why are they seeing that things will change so significantly? One is they just feel that the economy was stronger than they were expected. Yes, we went into a recession, but it was quite shallow. It wasn't massively long, and it didn't impact as many people as a normal recession would. It was a kind of like a blip, really, in the data. So that was positive. The main thing, though, for them is that unemployment is still pretty low. It's really quite strong, the employment status of UK PLC, and that they see sticking for the rest of 2024. They don't see massive rises in unemployment. That is what you would need in order for house prices to move significantly. Now, what they're also saying is they believe the forecasts on inflation, they feel inflation is going to drop to close to 2% in next month's data. We're very close to that now, so we'll find out that for sure. So that's interesting as well, that they feel the inflation data is definitely going to finally be put behind us. Consumer sentiment is getting stronger, so people feel the worst is behind us now, which is really good. That's what you want to see. You want to see positive consumers out there buying stuff, doing business, and all of that kind of wonderful stuff. So that is another reason for this. So that is pretty good. Now, because of the inflation side of things, they also feel that the Bank of England is going to drop rates faster and more than they're trying to let on at the moment. We had some data from the Bank of England the other day, or not data, we had reports of the Bank of England doing interviews and discussions where, for the first time in a long time, they spoke about potentially dropping interest rates. Now, Bank of England doesn't really like to do that. The Americans, the Federal Reserve, they talk about that kind of stuff. They say, look, we've got expectations to drop rates in America this many times. The Bank of England likes to be tight-lipped on that. But the Bank of England came out with a statement and said they could see themselves dropping interest rates before the Federal Reserve, which is quite a rare circumstance that potentially would happen. Now, Lloyds are saying that they feel that we will get 3 rate cuts this year. They will start in the summer and they will go down about 0.25% each time. Now, because of that, that's their belief, is that will stimulate the housing market. Their belief is that there are lots of people sitting on the sidelines. We've had people saying that for a while, that there are people that are ready to buy, that want to buy, that need to buy, but they're sitting on the sidelines waiting for that first Bank of England rate cut. And when that happens, maybe the mortgage rates don't go down as much, But the perception is that maybe the market's bottomed out at that stage. And so some people are waiting for mortgage rates to drop, the rate that you get, but some people are also hesitant to buy something because they watch YouTube channels where they're talking about the market crashing 35%, or they're reading that in the news and stuff like that. And that uncertainty, that is giving people a bit of reluctance to jump into the market. And so a rate cut by the Bank of England could signal to some people that are lurking on the sidelines that maybe the market is near the bottom. It's very hard to time the bottom of the stock market or the property market, but that could be an indication that people will come back into the market and the market could get moving again. So it's interesting to see that Lloyds have had a big turnaround. That is a big turnaround in their opinion on what happens going forward. And I do like to listen to banks. I do like to listen to their data, and I'll explain why. They don't have a crystal ball, but they do have data that nobody else has. The Lloyds Bank right now, they know the deals that are getting approved today, the deals that are going to complete this summer. They know that. They know the valuations that have been on their properties because they've sent their valuers round to those properties, right? And so they know how many people are applying for mortgages right now. They know how many people are getting agreed in principle for mortgages. They know the amount of transactions that are going through the works at the moment that aren't yet completed. So they have got a kind of crystal ball. Nationwide have the same. Halifax have the same. And so while we listen to Rightmove, we listen to the ONS data, we listen to economists and analysts, I do like to listen to the banks as well. Yes, they have a motive to keep the market up. They want to keep lending and all that kind of wonderful stuff. But they also have shareholders that they can't be massively wrong to. Lloyds would look a bit stupid if they say the market's going up 1.5% and it crashes 20% this year. They're not really going to be listened to by shareholders next time round. So they have to get it fairly close to the mark. And they have that insider data on the transactions that are going on. But what do you think? Do you believe that Lloyds have got this right? Do you think that house prices, rather than going down by the end of the year, could be positive 1.5%? Do you think that's possible? And what do you think about the 3 Bank of England rate cuts that they're expecting in 2024? Do comment below. Do smash the like button, subscribe. Go and check out some more content on the channel. Maybe go and watch this video right here.